The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Before we get into the technicals, let's have a quick look at what traders are watching. The Minneapolis Federal Reserve Bank President Neil Kashkari saying recent US inflation data has been, quote, quite positive, but some of the inflationary effect of tariffs may just be delayed. Meanwhile, European Commission President Ursula von der Leyen says the US has received the latest US document for further negotiations. In corporate news, Nike says it will cut its reliance on production in China to mitigate the impact of US tariffs on imports. Meanwhile, a White House official says the US has reached an agreement with China on how to expedite rare earth shipments to the US, and core consumer inflation in Tokyo slowed sharply in June due to temporary cuts to utility bills, but still stayed well above the bank's 2% target. Let's get into the technicals now. Ilya Spivak from tastylive joining us. Ilya, great to see you as always. What a night on Wall Street, the S&P 500 getting back towards record highs.
Very good to be with you, Juliet. And yes, indeed, we are watching the U.S. market seemingly shrug off virtually anything that the headlines throw at it. This is the current active September contract for the S&P 500 that we're looking at here. And we're seeing a push through the former June high there at about 61.28. That was, of course, the U.S. CPI report. Somewhere in there, in that range, you could barely notice there was a U.S. Iran-Israel war, not like the markets seem to pay very much attention. And we've broken higher, approaching the year-to-date highs here, right around that 6,300 mark. And this is a very important point here for financial markets. It seems like all of the worries that were there in mid-February that gave us that sell-off through early April around the implementation of the U.S. tariff regime, at least sentiment-wise, have been washed out.
All right, so sentiment-wise, washed out there in terms with some of the S&P 500. What about in the bond market, Ilya? Because the spotlight, of course, returning now to growth in the US economy.
Well, that's right, and this is why I make the point that sentiment-wise, this has been washed out, because the markets are sending us some very different signals when we look at the bond market. We've seen there's been this slow crawl higher for the 30-year U.S. Treasury bond. This is the futures contract on that. That, of course, corresponds with falling yields. And we see continued progress on this even after last week. The Fed told us not only are they in no hurry to cut, but their summary of economic projections that they updated actually had one fewer cuts over the outlook than they said in December or in March. So the Fed is seemingly retrenching on how much stimulus they want to offer, but the markets are pointedly going in the opposite direction. Yields are falling, and Fed funds futures anticipate that, never mind the Fed's forecast of only 25 basis points next year, they think the Fed is going to cut at least twice, and there's about a 50-50 shot at a third cut. So the markets are clearly seeing a reason for the Fed not to dither, and that may be suggesting that some of the more soggy U.S. economic data recently, today's aberrant durable goods report notwithstanding, is starting to raise growth concerns.
It is, and it's starting to really reiterate the likelihood that we will see some Fed cuts. What was your takeaway, Ilya, just on that point of the testimony we heard this week from Jay Powell?
The testimony was very much a repeat of what we've been hearing from the Fed chair since March, and certainly in line with what he said after the FOMC meeting last week, that basically they would be cutting already if they did not have this overhang of tariffs that they're not sure what to do with. They are saying historically this is bad for growth and can be inflationary, and they just don't know yet how this particular episode will go. So what they did in their summary of economic projections was decrease the outlook for growth, increase the outlook on inflation, and suggest that they're going to have less room because of that outlook on inflation to cut rates sooner. Whereas the markets are saying there is no ambiguity. You're already falling behind the curve. You've got to get a move on. And that's what we're seeing in yields here. So the markets are sniffing out some kind of a concern that the Fed is not ready to fully embrace, at least for now.
And it's all playing into the greenback as well, isn't it, Ilya, which fell to a 3.5-year low against the euro and I believe sterling as well. Great news for any of us here in Australia that want to travel. What are we seeing with the Aussie and the greenback relationship?
Well, that's right. So falling U.S. Yields obviously speak to a diminishing yield advantage for the U.S. dollar. And as the markets are screaming, listen, you need to get on with these rate cuts at the Federal Reserve, of course, the dollar is reflecting the same thing. Despite the fact that this has become a very consensus, very crowded trade, the dollar continues to sink. And what we have here for the Aussie, probably the most striking, the charts for the euro and the pound have been a little bit more vertical. The Aussie has been stuck in this very stubborn range, somewhere from the mid 6,300s into 6,550. Well, it looks like we've finally taken out that resistance. And this actually sets the Aussie up, it looks like, for a run in the direction of the 67 figure, that swing high there at 66.90 in view. This, of course, again, sort of echoes this idea that with China at standstill, as we're about to see in incoming Purchasing Manager Index data next week, with Europe at standstill, as we saw with the S&P Global PMIs this week, the U.S. is the only game in town. U.S. economic data, as we've just said, has looked a little bit soggier over the past month, and Citigroup data on economic surprises tells us this, that it's been fading. And if the U.S. falters, absent Europe and China as a backstop, nothing prevents a global recession. And so the markets are starting to say, well, if you're going to pressure the single point of failure, then the Fed needs to act, and it needs to act now. And of course, if they don't act, that run up into the highs on stocks starts to look vulnerable.
All right, well, Ilya, what is the key focus next? We've got the key PCA inflation data coming through Friday, your time.
That's right. I think that's the next big inflection point as far as economic data is concerned. And the worry here, I would argue, is probably not going to be a number that's too hot that would actually endorse what the Fed is saying and probably give a sense that the economy still remains relatively anchored. But if this number misses, as U.S. economic data has generally tended to do recently, then the markets are going to get a check mark on their side of the column. And the Fed is going to look increasingly behind the curve. So if the number looks soft and market dovishness seems right on that basis, stocks may find it difficult to hold up here.
All right, Ilya, always a pleasure. Thank you. Enjoy your weekend when you get there. Ilya Spivak there from tastylive. That does it for this edition of The Trade. Be sure to join us next time.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.